in this final stretch? Is the much talked about tech trade in some serious trouble or not? Let's ask someone who counts many of those stocks as his key holdings. Malcolm Ethridge with CIC Wealth. He joins me right here on our setup at Impacts. Good to see you.
Good to see you.
Now, are you going to tell me that's why I sold Alphabet, Scott, months ago? What do you make of what's happening in tech today? And as we ask that question at the very top, is this trade now in some serious trouble?
Yeah, so I know it might surprise you to hear me say it since you beat me up so bad the last time I saw you on selling that Alphabet holding, but I actually think what's happening in that name is a little overblown. I think that realistically, the little bit of give back they had in the cloud computing space really shouldn't matter in comparison to their core business, which is search, right? And so the fact that the market has penalized them for coming up short in cloud doesn't make a ton of sense.
All right, so Stephanie Link sees the pullback, as she said on halftime, and she buys the stock, right? It's a central question to the question I asked you, or central answer. Is the tech trade in trouble? Well, it is if it continues to go down and there are no buyers. The question is, people are going to buy the dip, and then that's going to hold up this trade despite what is an ugly day.
I think people are going to buy the dip just as a natural reaction because that's what we've been doing all along. And you also have the folks that were just kind of on the outside looking in the first half of the year. As far as tech is concerned, they rotated out in 2022 because that wasn't the trade in favor last year. So there's going to be some dip buying trying to make up for lost time, but I don't think that it's going to make enough of a difference. I think that Amazon is really what's going to make all of the difference when they report tomorrow. That's going to tell us whether mega cap tech hangs in there and we can turn the corner. As you said, Microsoft is doing everything they can to try and help out here, but really it looks like just the least dirty sock in the hamper right now for a market that's
why do you say Amazon is the key to the whole thing?
Well, because Amazon has the power to step in and reinforce what we've heard from both Microsoft in the cloud computing space, as well as Netflix in the digital advertising space, right? People don't really think about Amazon as a powerhouse in digital advertising, but they're in third place globally, right behind Meta and Alphabet. And so I think them telling us that they have positive numbers to report as far as digital advertising is concerned could be the thing that turns the corner there.
See, I thought you were going to say Apple holds the key. I mean, it's the biggest stock in the market. Now, it doesn't report this week, but there have been numerous announcements around the stock. First, you had, the issues in China. Is Huawei taking market share? Then they announced yesterday a new event for Macs. Then we hear today about raising prices. How much does Apple hold sway at this moment in where mega cap goes? Because that stock chart hasn't looked good either.
It feels like the market has already turned its back on Apple, right? You mentioned they have a China problem, right? That's 20% or so of their revenue. And then they also have a problem of diversifying their revenue mix, right? They have to get away from the 50+% that is the iPhone. But I think the market has already kind of baked that in and is now looking for another lead horse, which it looks like Microsoft is trying to take the helm as. And so as far as Apple is concerned, I think really as long as they don't come out and disappoint too much, we're already expecting another quarter of disappointing revenue numbers. I think as long as they don't come out next week and disappoint too badly, the market's already kind of baked that in. I think really Amazon is where the focus is going to be since Alphabet has kind of disappointed slightly.
I don't want to gloss over Microsoft at all because it is the only mega cap tech stock that is currently green, and you do own that.
Yes.
So how do we feel about this one now, given what their results were relative to what Alphabet delivered? You saw the reacceleration in cloud growth for the first time in a couple of years.
And we forgot all about cloud, right? Last year was all we could talk about, and this year we kind of forgot about it, right? And I think that Microsoft's story is compelling in the sense that they're now talking about marrying the cloud business with their AI capabilities in Azure, and that is what is leading to more enterprise sales near term, right?
Now,
so you have a lot of people trying out what they've brought to market so far, and they haven't really hit their stride as far as charging for it, which is a big deal for them.
Now, you don't own Meta.
I don't.
But now I feel like the pressure is ratcheted up. I love what Joe Terranova said earlier today, that the Magnificent Seven, at least in the current market, has become the Magnificent Five. Mm-hmm. Tesla reported earnings. That stock has not traded well at all. Now we have Alphabet down, as I see it here, near 10%. It's one of the biggest declines we've seen for that stock in a year. We cannot afford to keep chipping away at the Magnificent Seven and say, well, now there's only 5 that are good. Well, now there's only 4, because these have in large part held up the market in the absence of a lot of other stocks.
Yeah, I think that's a very good case. I think that we're running out of ways to explain away why the S&P is still doing well, right? We always say, well, if you strip out those 7, then the S&P is only, what, up 1% or so for the year. You're taking away more and more of that firepower, because if you take away Meta, you also take away all of the return it brought to the table through the year. You take away Alphabet, you take away 50% or so year to date, even with the give back. And so you're right, as you start to chip that away, you start to lose a lot of that argument. But I will say, in the defense of Alphabet, they're probably now fairly valued, where we were worried about all these tech companies being, average one of the Magnificent Seven is 30 or so times.
Yeah.
They're somewhere like 20. And so maybe it's now fairly priced, and it is a time to pay attention.
Oh, okay. I hear where this is going. So are you stating the case here that you're going to be coming back on with me and telling me that you bought the dip in Alphabet?
No, I'm not. So I said that I was selling it on the face that they were getting left behind in the AI conversation. They were going to give back a lot as far as search is concerned. And if you pay attention, Satya Nadella said, I want to make Alphabet dance, right? If you pay attention to the numbers that they reported a 10% growth rate in their search and news business. That wasn't lost on me. That's a really big deal, because every 1 percentage point that they can gain in market share away from Google is $2 billion estimated in revenue that they take away from their chief competitor. That's a really big deal to me. So I still don't think that from that perspective, right, 90+% of their business model is search. I just don't think that they can get away from cannibalizing their business, chasing the AI narrative.
You know what the interesting thing on that note is as well, is that if anything, what happens today is, at least, at the very least, from a narrative standpoint, Microsoft continues to distance itself from Alphabet, right? What was it, 3 whole points of Microsoft's growth came from AI, right? So that's just another reason for people to say, you see, that's the leader. The one that's down 10% today is the laggard. They had the opportunity to lead, and now they're going to trail.
Here's the thing that really jumped out to me in that report. Amy Hood this morning said something to the effect of at 11,000, I think, is the number of customers they had in the Azure business that were using their AI Copilot-enabled cloud business. That number's now 18,000 1 quarter later. So with that level of growth, that's where I see the trend line going for Microsoft. It's in that enterprise cloud enabled by AI. And I think November 1st, they're rolling out all the Copilots they're going to start charging $30 per seat for.
Right.
That's why, regardless of what happens in the broader market, as far as AI is concerned, Microsoft is the #1 true winner, save for maybe NVIDIA.
Yeah, well, because they have the ability to already monetize something that many people can't quantify at all, because it's such into the distant future. Now, there is another issue for the markets, which I want to bring in Lauren Goodwin today from New York Life Investments to join the conversation as well. And Lawrence, good to have you with us. I mean, this is like the bull's worst nightmare today. Not only is mega cap tech selling off hard, but interest rates are going back up. We can't have that. The 10-year is going back towards 5% as we speak.
What the market price activity has done today is confirm 2 trends that we're seeing make a big difference in a winning investment strategy for this period. The first is that there's really no clear macroeconomic narrative, and that means equity market leadership has been and is going to continue to give and taketh away. That means that stock picking quality earnings are high focus for us at this time. The second thing that's happening, or that we're seeing, is that the dynamic in technology is pointing to the reality that we're likely over the next 12 months to have to see a broadening exposure to some of the trends that have lifted technology this year. Artificial intelligence. So that means digital infrastructure. It might mean the small and medium-sized growth companies that are profitable, that are adding to this space, as opposed to relying just on the top 7 companies, as you've been discussing.
Do you personally think that the tech trade, Lauren, is in trouble more broadly?
I think it's in trouble for the specific 7 companies that have done so well this year, not because these aren't quality companies printing quality earnings, but because their valuations have already risen so high. Now, do these top tech companies, you see the sell-off and bring the market down with them? I don't think that that's the story that's going to lead the market back into bear market territory. I think that comes when we see recession come. And in that circumstance, it's not likely to be the top 7 companies that are really struggling. It's instead the market that struggles with a broader narrative around, where the economy is headed from here. And so the type of weakness that we've been seeing in the past couple of days, I think, is the market digesting earnings rather than a clear market signal.
Malcolm, we've gotten a little relief we thought, on rates up until today. And up until, this very moment is where we're, 5 basis points or whatever back to 5% on the 10-year. How problematic is this?
Yeah, I actually think it's a real problem. Like back in July, I think, late July, I was saying that we should probably be bracing for impact more than we're preparing for a soft landing, right? We wanted to applaud a soft landing. And I think the bond market is finally agreeing with me. So I was a little bit early maybe in saying that, but what we're seeing happening now in the fixed income market and the curve steepening, it basically is uninverting the yield curve, it's disinverting the yield curve, but it's not doing it in the way we want it to happen. We would want the Fed to be cutting short-term rates to bring it down organically, and instead yields are spiking really fast overnight, which is not a recipe for soft landing.
Yeah. Lauren, are we watching the chances for a late year rally literally evaporate before our eyes, given what's happening with the NASDAQ and then in the bond market?
I think what's happening in the bond market is particularly important in answering that question. The reality for the equity market is that, again, we're not likely to see a big bear market sell-off unless we're getting closer to recession. And as you know, that's been our call throughout the year. We've been dogged in it. And what we're seeing in the bond market is yields moving higher because the market is agreeing with the Fed that rates are going to have to be higher for longer. That is tightening market financial conditions. That is really challenging for borrowers, for economic activity. And so while it's only the latest in what has been a year-long trend in slowing economic conditions, I do think it makes a material difference and it is likely to sort of chart the path of markets moving forward.
The other idea, Lauren, is the more that bonds get cheaper and yields go up, they still present to many an opportunity that exists that's just better risk return than going into stocks. And, if you take cash is obviously attractive in that environment. If the prospect of yields continuing to go up means bonds are going to get cheaper, to some they're going to say, well, that's where the better value is today.
It's a really challenging task for investors to get back into the market or to think about how to enter the market given the cross currents that we're seeing. And while, yes, there's much to gain from sitting in cash at near 5% value, there are higher yields elsewhere, as you're pointing out. And so for an investor that's looking to get off of the sidelines, there are a couple of things that we're thinking very carefully about. The first is, where have there been structural changes in the market in the past couple of years that present potentially some more resilience in the economy? You and I have talked in the past about high yield bonds, typically not what you hold if you're worried about recession, but we see in the high quality segment of high yield, as an example, an opportunity to potentially see some more resilience than we typically have in the past. And for investors that are looking to get in because there's potentially more of a duration opportunity, there we see opportunity in the municipal yield curve where we haven't seen as much inversion, disinversion activity, and that sort of duration barbell is potentially quite attractive.
Yeah. What about other areas of the market? We spend so much time talking about Malcolm, technology, and for obvious reasons, it's the biggest sector out of the S&P. Discretionary, very weak today. There are concerns about what's happening with the consumer. What about staples, for example? Let's talk about investment ideas beyond what seems to take the day in the conversation every day.
Yeah, well, if you'll allow me, I think there's even opportunities within tech other than the Magnificent Seven or the S&P 7.
You've got a microphone on, the stage is yours, you're here at Impact, I will allow you.
Like, I think about a company like Spotify, right, which I own, right? It got whacked back in July because they announced a price hike and the market didn't like that. I bought more at 140 where it fell, and I'm glad today that I did because the market rewarded them now for these positive numbers. Daniel Ek basically told us in July, I think by Q4, you can expect us to actually turn the corner, right-sizing the company, getting away from, over investing into the podcasting business and cutting headcount and such. And the numbers they just reported a couple days ago bear that out, right? So if you think about a company like that isn't part of the Magnificent Seven, still is tech, but deserves some respect, I think.
Yeah. Lauren, what about other areas outside of, where Malcolm sees some opportunity and is, not afraid to step in? But what else is out there that looks decent?
Well, look, as you pointed out, there's been some more defensive tenor to the market in the past couple of days, with consumer discretionary and high beta looking a little weaker, utilities and staples looking a little bit stronger. But I'd caution investors not to take the bite too quickly when it comes to market leadership, because, again, the macro signals here are really mixed. And so, as you're both pointing out, good, old, boring quality is likely to be where the winners and losers come from for the next few months. And that means looking at interest coverage. It means looking at quality earnings. It means at reading the day-to-day signals of how these companies are performing, how they're passing costs on to consumers, more than what the macro environment's going to give them.
You know, what about, Lauren, D.C. risk? Well, we just had the election for the speaker. A hardline conservative win the Speaker of the House. We are going to be talking about government shutdown again as the calendar turns into November. I don't hear very many people talking about the risk of a real, legitimate and long-standing government shutdown and what the impact that could be on the markets, not even considering what's taking place geopolitically over in the Middle East.
Well, when it comes to the near-term impact of a government shutdown, we know that the longer the government has segmented closures, the more challenging it can be for a consumer that's already stressed by higher inflation, already stressed by higher borrowing costs. But when we look to the next 12 months, because we're just entering into the 2024 election cycle, we're really concerned about the conversation around fiscal sustainability moving forward. That's not to say that fiscal sustainability is a problem today, because as much as both sides of the government have been spending, nominal growth has been high, which can help to sweep some of that under the rug. But there's a real conversation around which types of programs, which we know impact sector winners and losers, are going to be seeing their light in the sun over the next year. That's going to be a under the macro surface, earnings quality type of story, but it's one that's going to start playing out, I think, very soon.
Malcolm, I'm going to let you answer that same question. Events that may have an impact on the market that, you know, to some degree, surprisingly, have not. Middle East, and again, the prospects of a government shutdown, drama in D.C., what has been a rather chaotic period down there. We finally at least have a Speaker of the House.
I'm going to go back to the economy, because tomorrow's GDP number scares me a little bit, right? I'm seeing economist estimates that it could be a 4.5% increase over last quarter, which flies in the face of a Fed that is saying that it wants to be able to bring spending down, get the consumer to chill out and stop spending, but the consumer is still going, right? Which means that, yes, we probably won't get that hike that everybody has decided we won't get at the end, was it next week? But we might in December, or we might in January, which could really make a difference, right? I heard you ask the question yesterday, are we closer to 4 or are we closer to 6 as far as the rate hikes? I'm concerned that the Fed could have to hike again, which could push us closer to 600 basis points, not coming in the right direction.
Yeah, I appreciate you being here. It's good to see you. Malcolm Ethridge here at Impact. And Lauren, we'll see you soon. I'm sure of that. We'll see you back at the New York Stock Exchange.